Okay, well, let's now connect with the management of KEI Industries. Mr. Anil Gupta, the CMD, joins us now on the show. Mr. Gupta, thank you so much for taking out time. We are, as we speak, on the cusp of a good amount of pickup in the economic activity from the corporate side, but guess what, even from the real estate and construction side. This is something, your EPC business is something that would tend to benefit quite a bit from this pickup, particularly on the real estate and concomitantly the construction side. So tell us a bit about that. On ground, have you seen a pickup in your EPC order book in particular on account of what we've been seeing?
Yeah, good morning, ma'am. See, as a policy, we had taken a view 2 years back to reduce our exposure to EPC business. We have been typically working in EPC on transmission and distribution segment, and mainly with the central government and state government utilities. So basically, because of the, working capital stocking, we decided to reduce our exposure into that. Our basic focus is now on the development of retail marketing, and whether it is the pickup in the economy is leading to growth in our demand for our cables and wires. We are primarily a manufacturing company, and we are seeing a very good demand for our wires and cables from construction sector, from infrastructure, real estate. So what you are saying is that there is a pickup. Yes, we are also seeing that, and we hope that our business will be benefited greatly with that.
So how much of your cables and wires segment, firstly, how much now comes from that segment, particularly the retail segment, like you mentioned, and, housing too, because the reason why I'm focusing on that is because obviously we are seeing a huge boom over there, in the sale of realty and then in construction too. So how much do you cater to that segment?
Our approximately 37% business is expected to come from retail, our distribution and retail network this year. And out of total turnover, around 10 to 12% will be coming from EPC. Rest will be coming from institutional business of wires and cables, which we sell to on B2B basis. So approximately, I can say that 50% business will be coming from B2B business, whether it is export or institutional market, 12% from EPC, and around 37% from the retail market.
Sure. Just wanted to understand, Anil, how is it that you're handling the raw material cost price pressure, and whether or not you're being able to pass it off to consumers directly?
We are absolutely able to pass the impact of raw material price increases to the customers. First of all, in retail, we always carry inventory, and all our prices are revised every 15 days as a policy. So far as institutional business is concerned, some of the contracts are on price variation basis. The contracts which are on firm prices, we ensure that we have sufficient raw material hedging or the raw material in stock or in pipeline for those orders. So we work on our value addition and our EBITDA and net margins, so we are not impacted by the pressures of raw material input cost increases.
Also wanted to understand where exactly is your current order book, and if you could break it down into segment wise as well in terms of order inflows.
Present order book is close to 3,000 crore, out of which around 1,300 crore is the order from our cable business, and around 1,000 crore is the pending order of EPC, and balance around 200 or odd crore are from exports. So far as retail is concerned, there is no order booking in retail. The order comes and dispatched within maximum 1 week. So we are maintaining stocks in several depots across the country as well as in our factories. So these orders are executed just in time on ex-stock basis.
But you would agree with me when I say that your top line right now will increase, but that's largely because of raw material prices. And despite uptick in top line, the return ratios will remain compressed. Is that a fair assessment?
You are right that our growth is expected to be more than 20% in this financial year. And definitely it is coming, the top line is coming from the increase in the input costs. In volume terms, it is slightly declined, but our margins, our EBITDA has improved compared to last year, and we expect that EBITDA will improve further in the coming quarters.
Because of COVID, every company has reinvented their cost structures, some by design, some by force. Some of the cost structures have changed permanently. What are the cost savings which you got because of COVID, where you think that that cost or that process or that entire chain is a permanent saving for you? What is this margin saving which you will get?
There are two types of savings. One, during COVID, certain amount of manpower left due to various reasons. So experienced that even with 20% of lesser manpower, we were able to cope up with the similar production and productivity, and even we were able to improve the productivity. Second aspect is that during this period, a lot of cost is reduced on traveling and other expenditure like events, etc., because of the COVID restrictions. So that is another cost saving for us. We have not tried to reduce our, do cost saving on advertising or our other promotional activities, but the cost is reduced because of no international traveling, very less domestic traveling, and arranging of events, etc., which we used to do for the marketing. And most of that it is done now on webinars and on Zoom or virtual
Always
meetings.
for taking the time out and speaking with us. Good to connect.